I'm with Kelly DePonte, Managing Director at Placement Agent Probitas Partners. Kelly, thanks for being with us at SuperReturn.
Sure.
So last year was a record year for fundraising with over 800 private equity funds closed and a record fund size per fund. What's your description overall of the fundraising market over the last 12 to 18 months?
It's been very, very robust. A couple of reasons for that. As people have gotten money coming back and exits from private equity fund, they've been looking to redeploy it back into the sector, so lots of money coming back into the sector. At the same time, there are a lot of investors like pension plans and the like, who are looking at their alternatives, where else could they put the money? And they find private equity to be one of the most attractive asset classes. So there's more money coming into the asset class as well.
Okay. Any regions that have experienced a notable increase or decrease in fundraising?
The thing is, in the private equity market, you have lots of niche markets, and sometimes it's hard to separate a real trend. Sometimes you have very, very large funds in niche markets that cause volatility year to year in fundraising that don't really mean anything. That being said, if you take a look at things overall, the biggest market in private equity is buyouts, and that has been continually growing. There has been a downturn in interest in emerging markets over the past year or so, in part in reaction to how attractive the developed markets are. If there's one spot that's a little bit unusual on the horizon, I would say it's actually Japanese buyouts. The market has not been very robust for at least a decade, and this spring we saw a number of closes of Japanese middle market focused buyout funds. So that would be more of a real trend, I think, as opposed to sort of a sudden blip on the radar screen.
Okay. Do you think that will continue?
I believe so. One of the things is that so many of those Japanese funds have raised right at the moment. They're now all out investing the money. I don't know if we'll have another little surge in activity as early as 2018, but if these funds continue to perform well, we could have more activity in Japan than we've had in a long time.
Interesting. Okay. In terms of asset classes, where are we seeing the strongest growth and demand thus far in 2017?
Still strong demand in buyouts. Probitas does a survey every year of investors and what they're looking at. And the three largest areas of interest was U.S. middle market funds, those funds $500 million to $2.5 billion. U.S. small market funds, those funds below $500 million, and then European country and regional focused funds, middle market again, buyouts. So that really has been the largest area of concentration.
So obviously the amount of dry powder is at an all-time high. Do you think this is more due to significant demand from LPs, or is it the fact that firms are struggling to execute on deals given competition and high purchase price multiples?
Yes.
Okay.
It really is both of those happening at the same time. There's a lot of fundraising that's been going on, so a lot of new money coming into the marketplace. Because purchase prices are high, the GPs are having difficulty putting money out, and so really over the past 4 years, we've seen a tremendous upthrust in dry powder to levels we've never ever seen before.
Okay. So what do you foresee in the coming years in terms of that level of dry powder?
Well, the thing is that if you look back in history, when you have a market dislocation, as we had with the great financial crisis, one of the first things that happens is dry powder goes up. Because what happened is deal making goes down in an uncertain environment. So it's hard to know when there might be a turn in the marketplace, but I would, if that happens in a year, 18 months, 2 years, I would expect dry powder to go up. Then what happens is that investors dramatically slow their commitment pace. You basically have a bleed off of excess dry powder until we're sort of more back to some sort of a normal level, and then it tears up again. But the real key thing is, when is the turn going to happen?
Right.
And nobody knows exactly when that's going to happen.
Okay. And then traditionally, large buyout funds have led the way in terms of returns. It appears now that the middle market is particularly attractive to LPs. Why do you think that's the case?
Well, I would disagree.
Okay.
The thing is, if you take a look at it over time, the middle market, top quartile returns from middle market funds have very often beaten large funds. That's been consistent across various market cycles. And I think it's the case right now. The key thing about that, though, is the spread of returns between top quartile and bottom quartile is much larger than middle market. What that means is if you pick the wrong fund, it's easier to lose money than it is at the buyout side, the large buyout side. The large buyout side tends to be a bit more stable with a narrower dispersion. It's less volatile. So I think people are attracted to the returns in the middle market, but it's one of those areas that you really have to be careful on your due diligence.
Despite the obvious uncertainty in the sector, healthcare just seems to be the hot one as far as sector-focused funds. What are your thoughts about that?
Well, when you're talking about healthcare, and to be clear distinction between life sciences, which is a venture capital style of investment, and you're really investigating totally new technologies. Healthcare is more focused on things like services. And there's a lot of interest in the buyout side of making the market more efficient, making healthcare delivery cheaper and more effective. And it doesn't really matter if you've got Obamacare or Trump care or whatever you want to call it. The impetus between making the market, which is a huge market for healthcare, making that market more efficient and with a better level of services is always going to be there.
Okay. We are increasingly seeing demand from LPs to GPs to develop long life funds. Can you talk a little bit about that?
Well, again, I think that there's some demand for long life funds, but it's not all amongst all LPs. The biggest demand for long life funds is from large pension plans, say in North America, and from some of the sovereign wealth funds. Those funds tend to have long-lived liabilities, and so they're looking to match their assets more against their liabilities. And it's less of an issue, say, for endowments and foundations, certainly not an issue for fund of funds and those sorts of investors. And so you're getting a lot of this impetus at the very largest end of the market with those sorts of investors. It's certainly attention catching, but I'm not sure if it's something that's going to be driving itself throughout the entire market.
Okay. Do you think that would change at all going forward, or do you think it's going to stay in those larger funds?
One of the things about long life funds is that if you're investing in a fund which has a 15-year life, a 17-year life, a 20-year life, you've made a commitment to that GP for that period. And this is blind pool investing. This is investing in illiquid positions with these funds. And there are still an awful lot of LPs who say, I'm not sure I want to lock up my money with a GP for that long. All sorts of things happen. People leave, they may have a difficulty with succession planning. So I want to have a shorter term. I'm more used to a 10-year life, and actually a 5-year investment life, as well as a 10-year overall life. So that when you need more money, you have to come back to me every 4 or 5 years, and I get to re-due diligence you and see if you're still worthy of getting that money.
I understand. Okay. One final question. We talked about 2016, we talked about 2017. Any predictions beyond this year, what you think might happen in 2018 or even beyond in terms of fundraising?
I'm frequently asked this question, and I'm going to break this down into two parts. If you look at the private equity market over the last 25 years, the trend really has been, as far as commitments to the asset class, up and to the right. Year by year by year, more money coming into the sector. The flip side of that is this market is cyclical. So you have a tremendous peak in fundraising during the internet bubble, and then a collapse. You have a tremendous peak in fundraising going into the great financial crisis as there was lots of debt in the market, and then a collapse in fundraising. Right now, we are at another market uptick and a peak. And in talking to a lot of LPs are worried that we are at a cyclical market peak. Nobody knows what the trigger event is going to be that might take it down. Most of those trigger events have actually happened in the public markets and then contaminated the private markets. And so if we have one of these market peaks, one of these market trigger events, we could have less fundraising at the end of 2017 and less fundraising at the end of 2018. That's not going to change the fact, from my perspective, that if you take a 7-year horizon, that there'll be more money in the market for private equity.
Okay. So it'll be interesting to see how it plays out. Well, thank you for speaking with us today.
Sure.